Hi everyone, my name is Tony Catt, here to talk to you today about ASX and investing in the share market. This is week 2 of our 4-week course, so thanks for joining us today. First and foremost today, I want to talk a bit about your return on your investment. How do you get a return out of an investment? And there are probably 2 major ways you can get a return out of your investment in a stock exchange sense. The first one is pretty simple, it's the income. So the dividends that you get are expressed or notified to you. The company announces a dividend. It's normally in the mechanism of a dividend per share, and then they pay the dividend out to you. And how that is basically expressed is the company, and I'm going to just use, for example, Commonwealth Bank shares. They announce of a dividend of $1 per share, and if you hold 2,000 shares, it's obviously $1 times 2,000 equals a $2,000 dividend. And that is ultimately then, typically dividends are paid every half year. Those dividends will come out to you normally when the company reports in probably March or February, March, and the other big reporting season is towards the end of the calendar year, around September, October. So they're the ways. The first way that you get a dividend or an income and a return on your investment. The second, and obviously, while I'm on that topic, the frequency of the income payments that you get from that could be different. A lot of companies will only pay dividends some only pay every year, so annually. Some pay half yearly, some pay quarterly, and some investments that you'll come across actually pay monthly. While I'm on the topic of income too, many companies, and it's probably changed over the last 10 years, many companies allowed you to do what's called a dividend reinvestment plan, DRP for short. So what that means is that $2,000 dividend that you get, you can elect through the paperwork. When you first join or buy the shares, is an election form. You get to elect whether you want to participate in the DRP, in the dividend reinvestment plan. Now, it just means that $2,000 dividend gets reinvested, and whatever the share price is that Commonwealth Bank is on that day, you will then incrementally add that amount of shares. So, for example, if the share price of Commonwealth Bank is, let's say they're $50, $2,000, you've invested $50 a share is an extra 40 shares. And that gets added to your 2,000 shares. So now you've got 2,040 shares. Now, that is some people like that dividend reinvestment method because it's sort of like the money you don't see is the money you don't miss mentality, and it's a great way of just accumulating shares. And sometimes you'll get them at a high price, sometimes you get them at a low price, but over time it helps build your wealth. Please note though, and what has changed over the last 5 years is that not a lot of companies offer that dividend reinvestment plan. So you be careful, don't just assume that every company has that. And secondly, if it does offer a dividend reinvestment plan and you're not currently in it and you want to go in it, you can speak to the registry and change your election. Just because you don't do it at the start doesn't mean that you're stuck without it. Capital growth is the other way you get a return on an investment in the share market, and capital growth is merely just, a reflection of the share price. So if you buy the shares at $2 a share and they then grow to $3 a share, that that's a gain of $1 per share. As a percentage of your original cost base at $2 means it's a 50% return. Now, remembering that the share price, as we talked about last week, can move up and down a lot, is that gain is not, crystallised or materialised, or won't materialise until you've sold the shares. In the meantime, they can go up and down as much as you like, and everything is just on paper, as they will say. Your gain is on paper. But that's what we refer to as capital growth. So you get an income, which is one component, and capital growth, which is another component. One of the other things you need to take into account, which I talk a lot about with people investing in the share market, is just making sure you understand risk and return. So when you're comparing risk and return, and I've got a clear saying around this that if it sounds too good to be true, it is that if you, at the moment, you want something low risk, capital secure, such as a term deposit or some cash at the bank, well, your return on that would be, at the moment, would be best part of 0.5% or 1% per annum. But because you take no capital risk by putting money into a term deposit and it's capital guaranteed, that's fair enough. But therefore, if you want to take further risk and you need to move up the risk scale, such as into the share market where your money can move around a lot and businesses do go bankrupt, let's be honest, is that then you expect a higher rate of return for that risk. And so it's you've got to be really clear that if you do take higher risk and you do think you are putting more capital at risk, that you expect a much higher return from that over time. When you're talking about investing in the share market as well, it's really important to talk about what the costs of doing the transaction are. And probably the biggest cost in a share market transaction is the brokerage cost, which I'll come to next. But a lot of people assume that you pay stamp duty on transferring shares. Now, all ASX listed share transactions, stamp duty got abolished, I think it was back in about 2001. So if you buy Commonwealth Bank shares or National Bank shares and you buy $50,000 worth, you do not pay any stamp duty. That's very distinct versus I'll call it a land investment or a property investment. The advantage of investing in the share market is that does not occur. There is a brokerage cost, however. So if you the cost of the transaction, there is a brokerage cost, and that can range from, depending on if you use an online broker, which might be $20 or $30 flat fee brokerage, and there's GST applied to the brokerage, and that's all. Versus up to some brokers might charge you 1% per transaction, and so for example, if you invest $100,000 in Commonwealth Bank shares, 1% of $100,000 is $1,000 brokerage plus GST. The brokerage is your only cost of doing that investment. The minimum investment is also worth talking about. The minimum investment in an Australian share market is $500. And so you need to have a parcel size per share of that. So if you go and buy BHP shares, you need to buy a minimum of $500 worth. Obviously $500 worth for some might not be worthwhile depending on the cost of doing the transaction. For others it might be okay. The other issue that we talk about when investing in the share market that's really important to remember is liquidity. And we talked a little bit about liquidity last week in terms of the buy-sell spread and making sure that you can get in and out of an investment. And different asset classes, of course, it's worth remembering, different asset classes have different liquidity. So cash is, of course, liquidity is defined as how quickly you can turn something into cash. So if you've got a term deposit that doesn't mature for 3 months, you might have to give them 30 days notice, and then it takes 30 days in this day and age to convert that into cash. If you've got a property, a residential property, and you put it up for sale, you might potentially, probably at best these days, liquidate that investment and turn it into cash within 30 days. But more often than not, it'll take 60 days, and sometimes it will take 90 to 120 days before you will turn that investment into cash. So that's the simple definition of liquidity. In an Australian share market sense, the liquidity is if you sell the shares today, you will turn that in, that'll settle in 48 hours, or 2 business days is probably a better way of putting it. 2 business days time. Money will be in your bank account, cleared and ready to go. So that is a really important definition of liquidity, and don't forget that all asset classes have different levels of liquidity, even managed funds. So if you have to lodge a redemption form, it has to get processed, they have to do the sell down, and maybe it could take between 2 and 3 weeks before you turn a managed fund into cash. And so from your investment portfolio, you need to be very aware of what your liquidity needs are and liquidity characteristics are as well. One of the other major factors you need to take into account when investing in the share market is tax. And I want to be, I'm not here to give tax advice, this is just probably just being general advice and factual, but there are a few key things that I want to talk about. The first thing that I want you to understand is capital gains tax. So clearly, if you buy Commonwealth Bank shares and you pay $10,000 for those, that's your cost base. That's what we refer to as your cost base. And you buy them, and then after 3 years, you sell those shares and you sell them for $20,000. And that's now known as your proceeds. What happens is, in a capital gains tax sense, we then take your proceeds, we take off your cost base, and it means you made what we call an assessable capital gain of $10,000. Now, what happens is, if, for example, first and foremost, this holding it for longer than a year means that, in this case we've held it for 3 years, means you get to reduce that capital gain by 50%. Which means now the capital gain that goes into your tax return is only $5,000 and not $10,000. Then what happens is that $5,000 gets lodged with your tax return, and if you're in your tax return and you're on a marginal tax rate of 30%, you'll pay 30% of whatever your marginal rate is, up to 47% potentially, on that particular number. So in this example, if your average tax rate, marginal tax rate is 30%, 30% of $5,000 is $1,500, and that's how much capital gain you will be assessed to pay. Of course, if the shares were held for less than 1 year, so you bought and sold them within 6 months, we will not get this 50% discount, and therefore the whole $10,000 will be put into your tax return and assessed at your marginal tax rate. Little things to note there is that if these shares are held in joint names, of course the gain is split. And the other really important thing to note here is that if you've bought Commonwealth Bank shares on multiple occasions, so you might have bought them in 2016, and then you bought some more in 2018, and you bought another parcel of them that cost you $12,000, is that you can actually pick, depending on how many you sell, you can pick which parcel you want to allocate the sale to. And it's probably beyond the scope of this particular video, but you just don't have to assume that it was the first ones you bought or the first ones you sell, or the last ones you bought or the first ones you sell, and so on. So make sure, and the reason why it's really important to understand this is you can select a parcel and a cost base against which is more favourable for your tax outcome. So make sure you talk to your accountant about that. The second really major thing that I want to talk about in a tax from a share market point of view is franking credits. So when you get dividends, people get this thing called franking credits, or imputation credits as otherwise they're sometimes referred to. And a lot of people, understandably, don't have a tax background, don't understand what these things are. And so in a real simple sense, if a company makes a net profit, and I might use a different pen because this one is starting to die on me, but if a company makes a profit of $100, and so Commonwealth Bank makes a profit, and it's probably not $100, it's probably $100 million, or it's clearly $1 billion in a lot of cases, but for the sake of that, now all companies in Australia pay tax at, and I'm going to simplify it again, at 30% corporate tax rate. So the corporate tax rate is at 30%. It means their $100 net profit gets taxed, and they lose then $30 tax, which leaves them with $70 profit left over. Now, assuming they then say, yep, we're going to distribute all of our profit out as a dividend to our shareholders, and they 100%, so they send you a cheque for $70. So that cheque for that dividend comes to you because you're the shareholder, you get a cheque for $70. But it's what they call fully franked. You might have seen the term FF by the statement, or you hear you say it's fully 100% franked. You'll see this term from time to time. Now, what that means is, though, you can see that already $30 has gone off to the Australian Taxation Office. Great. What used to happen, and I think the biggest part of this story that I'll allude to here, is that it used to work that this dividend used to come out to shareholders, and they used to tax it again at your marginal tax rate. And if your marginal tax rate was 47%, you lost nearly $4 of that again, meaning that you're only left with $36 after tax. So the company made $100. The ATO got this $30, but it also used to get that $34 as well. And so the $100 that was made got taxed twice. It was the double taxation. It got taxed at there, and the ATO received $64 out of the $100. And back, the best part of 30 years ago now, that was abolished. That double taxation system was gotten rid of, and this franking credit system was implemented. So now what happens is much fairer, and it's much more fair for each individual's tax circumstance. So now they say, no, you don't have to pay marginal tax on that amount again. However, we know that $30 has been paid already, so they do what they gross up for the amount that's already been paid to the ATO, so they add that back. They say, right, technically there was $100 made on that investment in an income sense. That then is times by your marginal tax rate, and if your marginal tax rate is 47%, as we talked about before, that means you get assessed at $47 on that. But we know that $30 has already gone to the ATO. The ATO has already got one part of the pie of your 47. So what they do then is they say, right, we'll give you back your franking credit or imputation credit of $30. Means that there's only $17 left over to pay. So the ATO then has got the $17 and they got the $30. They got their slice of the tax cake, which is fine, and no one argues with that. But it did it at the appropriate tax rate that was for that particular investor's personal circumstances. Now, I'll give you another example. What if you were doing this through a super fund which doesn't pay any tax? It means that the marginal tax rate of the super fund or the pension is zero. You get the credit back because the ATO has already got the $30. Means, hang on, we'll give you back $30, and you will see that means that you get a refund of the $30. Which is, so if you're in a zero tax environment, you shouldn't have to pay any tax, and hence the $30 comes back to that investor, and you receive the whole $100, the $70 there you got in cash, plus the $30 refund. You got the $100 dividend that was made right at the start. It's a fair system. It works very well depending on your tax rate. So in summary, when you're considering an investment in the share market, there's certain factors that we've covered off on here that you need to look at. So we talked about capital and income and how you get a return, how secure is that income, and how often does it come to you, and ultimately the income is relatively predictable in a share market sense. And what I mean by that is that even during the GFC, income, even though the share market fell nearly, or probably approximately 40% in a capital sense, the income that was coming out via dividends only fell by 9%, which means that you've got to watch the two factors. You've got to watch your growth, but you've also got to watch your income, and the income can be a lot more stable than people think. We talked about risk, just what is risk, and you need to consider each individual share about how that is and what risk you're taking. We talked about transaction costs with brokerage and how there's no stamp duty, minimum investment amounts, how much you're going to invest and how do you want to approach it, liquidity, how quickly you can turn it into cash, lastly, the taxation. Understand franking credits, understand capital gains tax, and understand how that all works. So one of the other things that we wanted to cover off on is buying and selling shares and how you do it. And I did sort of touch on this last week in that you can use a full service stockbroker, you might use a discount stockbroker, you may use an online service such as eTrade or CommSec. But ultimately, no matter which mechanism you use, there's certain things that you probably should know. And we talked about the trading hours last week, and that's important to know. But ultimately, to buy and sell shares, you need to open an account, first and foremost. I know that sounds obvious, but that's actually probably the hardest part about the whole process is opening an account. And you need to know, therefore, what name and structure you want to put those shares in. So do you want it in your name? Do you want it in joint names? Do you want it in a family trust name? Do you want a company name? And so that's where the taxation and the I guess the registration process can be correct in the sense that you can get all that right from the start. So then you'll fill out the application form, you'll submit all the paperwork, and you'll be then issued with what we call a HIN number, a holder identification number. That'll be a 10-digit number starting with an X. That is like I'll call it like a PIN number at a bank, where each of your shares will be then digitally kept under that HIN number, which makes administration a lot easier, such as that if you want to go and change all the, you change bank accounts where you want dividends paid, you can change the bank account once, it's all linked to that one HIN number, and all the dividends change to your new bank account. It might be a change of address, so you change addresses. Again, you change address once via that HIN, which means you need to go back to your broker or your online broker, notify them of the change of address, and then that change of address will go straight throughout all of the shares in your portfolio for that HIN number. Now, if you choose not to be on CHESS and you choose to have them on what we call a shareholder reference number, SRNs as they're effectively known, the shares on your statement will begin with an I. It means that then you'll be forced to go and notify each individual registry for each shareholder reference number of either your bank account details or your change of address details. So CHESS has a lot of administration benefits around it, but you need to go through an online broker or broker to get that number in the first place. Once you've got the CHESS set up and the bank, you have to link a bank account to it. So we need to know dividends, because in the good old days when I was a young boy, there was cheques sent out and everyone used to get a cheque. Nowadays, the registries all refuse to send out cheques, which I guess is understandable in this day and age. And so if you don't link a bank account, then you won't get your dividend. I want to make that pretty plain and simple. And so you have to link a bank account. It makes it much easier also for your accountant, I will say as well. One of the other things I want to touch on right now, and we do talk about record keeping a little later on in this topic, is it's really super important you keep good records and you make that side of your life easy. It's the longer you leave it in terms of recording what you paid for things, recording what you get for the dividends and any transactions you make or changes you make, the harder it is for your accountant, the harder it is for the people around you, the harder it is, I'll call it, for your loved ones, ultimately if you pass away, to try and reconstruct what your portfolio was meant to look like for the last 10, 20 or 30 years. So make sure you keep good records. So now your account's set up, you're ready to go. Now you can place an order via ringing your stockbroker and buying a certain amount of shares. So you ring up and you say, I want to buy $5,000 worth of Commonwealth Bank shares. There's two bits of language you need to know there. There is what we call buy at market, which just means that stockbroker, the minute you give that order or you place that order online and you issue a market instruction, that order will go through the market literally within seconds. There won't be any delay, it'll just happen. And so whatever the prevailing price is at the time you email or call or put it online is what you will get. The second thing, and that may be okay, so there's an instantaneous reaction to that. If you say, I want to buy $5,000 worth of Commonwealth Bank shares, but you want to say, I want a limit order, so it means you won't pay, I don't want to pay more than $80, Tony, for those shares. That is fine too. So your order will go into the market, it'll be limit order at $80. So until the Commonwealth Bank shares get to $80, your order will sit there. Now there are two provisos to that. That order normally will get what we call purged within 30 days. So the old orders normally just come out of the market and purged, and you need to then reinstate them so that they go back into the market. The other way that these orders get purged out of the market is if the stock pays out a dividend or there's been some corporate activity, the order will also come out of the market and you'll have to reinstate it. So please understand there are two ways of placing an order: at market or at limit. The other thing that gets often misunderstood with placing an order is be really crystal clear about whether you're placing a dollar value order, $5,000 worth, or 5,000 shares. I typically like to work in dollar terms, but it's each to their own. But there's a big difference between buying $5,000 worth of Commonwealth Bank shares and 5,000 Commonwealth Bank shares. And what I mean by the difference, I'm talking hundreds of thousands of dollars. So be crystal clear about your language and what you want. And, you know, probably just while I'm on the topic, don't send an email. If you want an order done, anything done urgently, ring or, you know, speak to somebody, because if it's not urgent, that's fine too. Email is fine. But if you want an order done straight away, do not email, because people aren't on email all the time. So while we're on the topic of how you can buy and sell a share, there's one other thing. Finding a stockbroker is really a personal choice, and you can get recommendations from friends or go online and get recommendations that way. But ultimately, one of the things I just wanted to point out is that if you want to change stockbrokers also, that's a relatively painless process in this day and age. Now, again, in a sense, that HIN number that we talked about, that is a HIN number that you can take with you wherever you want to go. So if you want to change stockbrokers and you want to go from Macquarie Group to Morgan Stanley, and that's a shout out to those two, no free plugs around here, but is that just for example, you can then, you need to, the broking firm you're moving to with your shares, they're the ones that need to set up your new account, they lodge or get all your paperwork in order, and then they request a HIN transfer from your old stockbroking firm. And basically there is a certain protocols and timeframes that should happen within, and all the stock moves from Macquarie Group to Morgan Stanley in, generally it should be in a matter of days once that paperwork is lodged. Now, a couple of things to remember here is that please get your background information and cost basis transactions and everything you need from the old stockbroker before you leave. Because once you're probably left, I would argue some of the records might get archived or put somewhere that maybe is not so easy to get anymore. Get all the information you need, then transfer, and make sure your new receiving broker has got all the right details for you. That can become pretty crucial down the track. Probably another thing to add to the stockbroking community is that you can have more than one stockbroker. So you don't, if you wanted to use both Morgan Stanley and Macquarie for your stockbroking requirements, that is fine too. You will have different HIN numbers though. You can't have the same HIN number at both brokers, which is fine. And ultimately you can use both brokers to operate within the same entity. So if you've got a self-managed super fund, both brokers can be registered. You can register accounts with both firms, and you can buy and sell shares with both stockbroking firms. So it's not necessarily just a one-size-fits-all approach. You can use multiple people for multiple accounts. So with ASX trading and settlement, we talked about a mechanism called CHESS, Clearinghouse Electronic Sub-Register System. And CHESS is that X number that we're referring to before, that you'll register your number. Now, we will send you out the notes and you can read about this in detail, but there's probably a couple of key things I want to talk about with this is that you will not receive CHESS notifications of your holding all the time. When you make a change, CHESS will send out to you and post out to you a notification, a CHESS holding form of saying, yep, you've registered, you bought 2,000 Commonwealth Bank shares, here's your change in holding, and you get a statement. So there's no certificates anymore, like the old days where you got a CBA certificate registering your 2,000 shares and you had to hang on to that certificate to prove that you own the company. There's none of that anymore. It's just a piece of paper that will come in the post saying, here's your 2,000 Commonwealth Bank shares. If you then subsequently 2 years later sell 1,000 of those Commonwealth Bank shares, CHESS will then send you another form within, and generally they process them at the end of the month, so don't expect they're going to come out instantaneously either. They normally do their processing at the end of every month. If you sold it on the 12th of January, you might not see that new paperwork until the first week of February. So don't panic if you don't see it. But the new form that will come out will say you held 2,000, less 1,000, your new holding is 1,000, and it'll show you that. It won't show you the price you paid, it won't show you the price you sold them for, it'll just simply show your shareholding movements, and that's what CHESS will do for you. One of the other things we get asked a lot about is we can move shares. Maybe you want to gift 1,000 Commonwealth Bank shares to a child or a grandchild. And I just want to talk about what we call off-market transfer forms. So you can use an off-market transfer form, which then is moving the Commonwealth Bank shares, say, from the name of Tony Cat into the name of my son Angus Cat. And ultimately that form means I don't have to pay brokerage costs to sell 1,000 Commonwealth Bank shares, and then I don't have to pay brokerage costs for Angus to buy 1,000 Commonwealth Bank shares. I simply fill out the form, and it's like I'm the seller, Angus is the buyer. We both sign it as buyer and seller, and then we lodge that off-market share transfer form with the share registry or with our stockbroking firm, and then they will do the paperwork behind the scenes. It's sort of like a pseudo conveyancing mechanism where we're changing ownership of those shares. Now, if you, in this case, I can't move my 1,000 Commonwealth Bank shares to Angus because he's under 18. So he is not of legal age to hold the shares in his name, which means that then I'll move them to, you need some trustees of those shares, which typically I find would be parents or grandparents whose names sit on the shareholding form. So it's Tony Cat, and Lisa Cat, my wife, as trustee for Angus Cat. He can then hold those shares until he's 18, and then we can sign them over when he's of legal age, and then he can own them in his own name. So the last thing I just really want to talk about today is record keeping, and I touched on that throughout today's talk. I can't emphasise this enough to get your record keeping right. And the first, I'll call it source of truth, is your contract note. The contract note, when you buy 1,000 Commonwealth Bank shares, the stockbroker will send you a record, as we call it a contract note, that will show you the date of the transaction, that will show you the amount of shares you bought, the price you paid, the brokerage you paid, and the total amount that you are going to pay for them. And you can, it will show you the settlement date. Now, while I'm on the topic, so make sure you keep that form and or record it in an electronic system, record it in an Excel spreadsheet, put it somewhere that you're going to remember it and you're going to use it in the future. Just while I'm on that, with that contract note, it will also show BPay details. So if you want to BPay those shares and pay for them through your bank account instead of doing an EFT or direct debit, you can BPay those shares, and all the brokers will show you the BPay details. So you need to keep good, strong records through those contract notes. There is a number of different online platforms, software platforms. Everybody does it differently, but just make sure you pick a way and do it, because as I said earlier, the amount of cost that you will rack up in accounting costs or administration costs down the track trying to reconstruct 5, 10, 15 years of share transactions is just a nightmare. Make sure you keep the contract notes and record it properly. The second thing that you'll need to do is make sure that if your shareholding changes, and I know, and it's simply in a sense that you record whether you sell something or buy something, but also if you have dividend reinvestment plans, you need to record all those, which we talked about earlier as well. If you take up extra shares through a rights issue, which we'll talk about later on in this course, you need to record how many extra you took up. And during COVID, there was an enormous amount of share purchase plans as well. So they were taking up an additional, potentially up to $30,000 worth of new shares. Again, record it. What you'll find, the reason why those DRPs and share purchase plans are a little bit more, you've got to stay very vigilant with that, is that you don't get a contract note for those. It's not like your typical buy and sell transaction. So you will see a CHESS statement come back to you and say, hey, you've been allocated a certain amount of new shares. But you've got to make sure you know how much you paid for those shares, how many new shares you got, and at what date. And so you need to be very vigilant about your record keeping with those particular things. One of the other things that I guess also wanted to touch on was, just before we go today, is just reading the financial press. And I may have mentioned that you've got to be really careful having lots of voices in your head in terms of who's giving you advice around the share market. But make sure that it's probably nice to start reading the business section of the Advertiser, or maybe picking up the Financial Review on the weekends. I find is quite useful because it's probably a good summary of the week. Or even just subscribing online to the Financial Review or some other business news. Reading financial press can start to give you an underlying level of knowledge that I think is important. Even just looking up, make sure that you understand how to read the share market tables in the Advertiser, for example, how to look up the price, which will show a high, a low, a close, the amount of shares that were traded on a day, and those sort of simple things. Make sure you understand how to look all that up, which will give you a greater understanding of what the share market's about and how things are moving around. But I'll say all that with a clear caveat, just to make sure you don't try and do too much at once. People's knowledge takes time. It's walking up the stairs in terms of just incremental knowledge. You will build on your knowledge in the share market. You will not wake up magically one day and know all there is to know about the share market. Give yourself time, be patient, and you will get there. But you need to do some of these little things, such as reading some other press and so on, just to make sure you are working on this. Thanks for joining me again today. It's been great to see you all, and I look forward to catching up with you in week 3.